Imagine waking up one morning, checking your bank account and seeing a steady stream of income flowing in, without having to work a single extra hour. Sounds like a dream, right? But for many smart investors, this is a reality. And the secret behind it? Dividend ETFs. These funds can provide a consistent source of passive income, helping you fund your retirement without the stress of constantly managing individual stocks. In today's video, we're going to break down everything you need to know about dividend ETFs and how they can be the key to a financially secure retirement. We'll cover why they are one of the best passive income strategies, how to choose the right ones, and how to incorporate them into your retirement plan. By the end of this video, you'll have a clear roadmap to building a portfolio that pays you, month after month, year after year. But before we dive in, if you want more insights on how to grow and protect your wealth, don't forget to subscribe, hit the like button, and turn on notifications. It really helps the channel and ensures you don't miss any of our future content. Dividend ETFs are a powerful tool for investors who want to generate passive income without constantly monitoring the stock market. Unlike individual stocks, which can be unpredictable, these ETFs pool together dividend-paying companies, offering stability and diversification. And the best part? They distribute dividends to investors regularly, creating a consistent stream of income that can help cover your expenses during retirement. What makes dividend ETFs so effective? First, they provide exposure to a variety of companies across different sectors. This means that even if one company faces financial trouble, your entire portfolio isn't at risk. Second, they are professionally managed, meaning experts handle the selection of stocks that provide the best long-term value and dividend payouts. Finally, they offer automatic dividend reinvestment options, allowing your earnings to compound over time and grow your wealth even further. You might be wondering, how do you pick the right dividend ETFs? With so many options out there, it can feel overwhelming, but don't worry, we'll break it down step by step. First, you need to decide between high-yield ETFs and dividend growth ETFs. High-yield ETFs focus on companies that pay high dividends right now, making them ideal for investors who need immediate income. However, some of these companies may not sustain their high payouts over the long term. On the other hand, dividend growth ETFs focus on companies with a consistent track record of increasing their dividends. While the yield might be lower initially, the potential for growing income over time makes them an excellent choice for long-term retirement planning. Next, look at the expense ratio. This is the percentage of your investment that goes towards management fees. The lower the expense ratio, the more of your money stays invested and working for you. Ideally, you want an ETF with an expense ratio below 0.5% to keep costs low. Another key factor to consider is diversification. You don't want all your investments concentrated in just one industry. Look for ETFs that spread their holdings across different sectors, such as technology, healthcare, and consumer goods. This ensures that your portfolio remains resilient even if one industry experiences a downturn. Once you've selected the right dividend ETFs, the next step is to integrate them into your retirement plan. This means deciding how much of your portfolio should be allocated to dividend-paying funds. A good rule of thumb is to maintain a balance. Too much in high-yield stocks might expose you to unnecessary risk, while too little might not generate enough income. If you're still in the accumulation phase of your retirement journey, consider reinvesting your dividends. This strategy allows your portfolio to grow faster by using dividend payouts to buy more shares, compounding your returns over time. However, if you're already retired, you can set up a systematic withdrawal plan to receive regular payments from your dividend ETFs, ensuring you have a steady cash flow to cover your living expenses. And don't forget about taxes. Depending on where you live, dividend income may be taxed at different rates. Some investors choose to hold their dividend ETFs in tax-advantaged accounts like IRAs or Roth IRAs to minimize tax liability. Understanding how taxes impact your dividends can help you keep more of your hard-earned money. Now let's talk about risk management. While dividend ETFs offer stability, they aren't completely risk-free. Market downturns, changes in interest rates, and company performance can all affect dividend payouts. That's why it's essential to review your portfolio regularly and rebalance it as needed. Consider holding a mix of dividend ETFs, bonds, and other asset classes to ensure your portfolio remains well diversified and protected against market fluctuations. To illustrate how powerful this strategy can be, let's look at a real-life example. Imagine an investor who started with a $100,000 portfolio of dividend ETFs and reinvested dividends for 20 years. With an average annual return of 7% and consistent dividend reinvestments, that portfolio could grow to over $400,000 without adding a single extra dollar. And once they start withdrawing dividends in retirement, they could be receiving thousands of dollars per year in passive income. This is why so many retirees and financially independent individuals rely on dividend ETFs as a key part of their strategy. They provide peace of mind, knowing that no matter what happens in the stock market, a steady flow of income will continue coming in. Beyond the basics, there are several advanced strategies you can implement with dividend ETFs to maximize your returns. One approach is to create a dividend ladder, where you invest in ETFs that pay dividends in different months of the year. This ensures you receive income every month rather than just quarterly, helping to smooth out your cash flow. Another strategy is geographic diversification. While many investors focus solely on U.S. dividend stocks, international dividend ETFs can offer higher yields and exposure to growing economies worldwide. By allocating a portion of your portfolio to global dividend payers, you can further reduce risk and potentially increase your income. It's also worth considering the sector allocation within your dividend ETF portfolio. Traditionally, sectors like utilities, consumer staples, and telecommunications have been known for their high dividend yields. However, in recent years, technology companies have also started paying significant dividends. A well-balanced approach across these sectors can provide both income stability and growth potential. For those approaching retirement, a strategy known as the bucket approach can be particularly effective. This involves dividing your portfolio into 3 buckets: short-term needs, cash and highly liquid assets; medium-term needs, including some dividend ETFs; and long-term growth, which might include dividend growth ETFs. This structure ensures you have immediate access to funds while still allowing the bulk of your portfolio to continue growing. Remember that market timing is rarely successful for long-term investors. Instead of trying to predict market movements, focus on consistently investing in quality dividend ETFs through dollar-cost averaging. This means investing a fixed amount regularly, regardless of market conditions, which helps to reduce the impact of market volatility on your portfolio. As your retirement date approaches, you might consider shifting some of your holdings from dividend growth ETFs to higher-yielding options to increase your current income. However, be careful not to sacrifice long-term growth entirely, as retirement can last several decades, and you'll need your portfolio to continue growing to combat inflation. Speaking of inflation, it's a silent threat to retirement income. The good news is that many dividend-paying companies increase their payouts over time, often at rates that exceed inflation. By focusing on dividend ETFs that hold these dividend growers, you can help ensure that your purchasing power remains intact throughout retirement. So, to recap, dividend ETFs are an excellent tool for generating passive income and funding your retirement. They offer diversification, professional management, and compounding growth potential. By selecting the right ETFs, reinvesting dividends when possible, and balancing your portfolio, you can create a retirement plan that works for you. The journey to financial independence isn't about getting rich quick. It's about making smart, consistent investments that generate reliable income over time. Dividend ETFs represent one of the most accessible and effective ways to achieve this goal. Whether you're just starting your investment journey or are already approaching retirement, incorporating these powerful funds into your strategy can help secure your financial future and allow you to enjoy the retirement you've always dreamed of. If you found this video helpful, make sure to give it a like, subscribe for more investing insights, and let me know in the comments, are you already investing in dividend ETFs? What's your favorite strategy? I'd love to hear your thoughts.